Welcome everyone, and thank you for joining us today. I'm excited to kick off this presentation on our investment analysis and price targets as of May 2026. Today, we'll be exploring some of India's leading companies across various sectors, including iron and steel, oil and gas, power and aluminium metals, among others. We'll also highlight 5 pure-play giants and discuss the historic demerger that's shaping India's next era of growth. So, let's get started and see what opportunities lie ahead. Let's start by clarifying that this isn't a loss, but rather a mechanical value redistribution across 5 entities. You can see the share price on the ex-date has decreased from Rupee 773.60 to 289.5, which reflects the split. We also expect the listing of 4 new entities around June to July 2026. The record date, which is a market holiday, is set for May 1, 2026. The ex-date, when the stock will trade without the spin-off, is April 30, 2026. And the last date to buy shares to be eligible for the demerger is April 29, 2026. Now, why are we doing this split? Historically, Vedanta operated as a diversified conglomerate, covering metals, mining, oil and gas, and power, all under one stock. This structure created what's called a conglomerate discount, where the market tends to undervalue each individual high-quality business because they're bundled together. The solution is to split these businesses into separate listed entities. This way, global investors, whether sovereign wealth funds, sector-specific funds, or retail investors, can invest directly in the particular business they're interested in, without the discount applied to the conglomerate. As for the structure, it's straightforward. One Vedanta share will convert into 1 share in each of the 4 new companies, maintaining a 1:1 ratio. Shareholders, as of the record date, May 1, 2026, will receive all 4 new shares. In essence, this demerger helps unlock the true value of each business by giving them their own independent listing, making them more transparent and better valued by the market. Let's take a closer look at Vedanta's diversified portfolio across various sectors. Starting with iron and steel, the company is heavily focused on iron ore and steel operations, and what's notable here is their near-zero net debt position, which highlights strong financial discipline. India's burgeoning steel demand acts as a significant tailwind, and their long-term capital expenditure plans are well aligned with the ongoing infrastructure boom in the country, supporting growth prospects in this sector. Moving on to Vedanta Iron and Steel, identified by the ticker VISL, this is a focused E&P entity in Rajasthan. They own oil blocks and are targeting zero net debt at the time of their listing. Plus, there's considerable potential for ramping up production, which could boost their future revenues. In the power sector, Vedanta Oil and Gas, or MEL, operates a 1,980 MW thermal power plant in Punjab. They benefit from stable, long-term power purchase agreements, which provide steady cash flow. Like others, they aim for near-zero net debt at listing, emphasizing their focus on financial stability and consistent income streams. Turning to Vedanta Power, or TSPL, this is India's largest aluminium producer. Recognized by ICICI Direct as the most attractive demerged entity, they hold the largest bauxite and coal assets, which are crucial for their operations. They are also in the story of EBITDA margin expansion, promising improved profitability. Finally, Vedanta Aluminium, or VAML, holds a core 64.9% stake in Hindustan Zinc, making them a dominant zinc, silver, and lead producer. Their goal is to maintain zero debt in their oil and gas segment and continue to strengthen their position. They are expected to remain a part of the Nifty Next 50, which underlines their importance in the broader index. Overall, Vedanta's strategy of maintaining financial discipline, leveraging sector tailwinds, and focusing on long-term growth initiatives is quite compelling. It aligns well with the overarching theme of sustainable value creation and sustained expansion across their diversified sectors. Let's take a closer look at the debt allocation across our different entities following the demerger. Starting with VISL, the iron and steel segment, we see that it has a low, near-zero net debt position at the time of listing. Similarly, MEL, our oil and gas business, also maintained a low net debt level. TSPL, operating in power, falls into the same category with low net debt at the outset. Moving to the medium debt categories, VAML, which handles aluminium, has a net debt to EBITDA ratio that aligns well with its earnings strength, indicating a healthy balance between debt and earnings. Vedanta Limited, which is residual, maintains a net debt to EBITDA ratio that aligns with its debt servicing capability, ensuring sustainability. Now, looking at Vedanta's overall financial strength, we see a net debt to EBITDA ratio of 0.95 times, which is quite impressive. This ratio has increased by 900 basis points year over year, reflecting a strategic adjustment as we strengthen our financial position. Our EBITDA margin has grown significantly, up 44% year over year to 59%, demonstrating improved efficiency and profitability. In terms of absolute numbers, our EBITDA has surged to 18,447 crore rupees, up 29% compared to last year. Revenue has also seen remarkable growth, reaching 51,524 crore rupees, which is an 80% increase year over year. Finally, net profit for Q4 FY26 stands at 9,352 crore rupees, marking Vedanta's strongest year ever in terms of financial performance. This overall picture underscores our robust financial health and the successful execution of our strategic priorities. Let's take a closer look at the valuation highlights for these key entities. Starting with the steel sector, the demand tailwind is clearly supportive, and what's notable here is that these companies carry near-zero debt, which is a strong positive. The specific targets for these new entities are still to be determined, pending SEBI listing approval and price discovery, but they are categorized as small-cap companies, focusing on iron and steel. Moving on to the oil and gas sector, VISL is also near zero debt and positioned as a growth play in exploration and production. Again, the exact valuation will be determined at listing, so stay tuned for that. In the power sector, MEL shows a stable cash flow profile thanks to its PPA agreements, and its target price is yet to be finalized, but it's also a small cap. For the large caps, TSPL stands out as the most attractive entity, with a target price of over 400 rupees, making it a key investment focus. In the aluminum sector, VAML has a fair value estimated around 300 rupees, based on analyst Tapan Doshi's assessment, with a target range of 300 to 325. Lastly, Vedanta Limited in the zinc and HZL segment is a residual entity, with its valuation incorporated into the overall sum of the parts. When we combine all 5 entities, the total valuation comes to approximately 820 rupees per share, compared to the pre-split price of 773.6. This overall valuation reflects the potential of these diversified assets, anchored by their robust sectors and strong financial fundamentals. Let's start with a quick disclaimer. This is purely an informational analysis. Always remember to consult a SEBI-registered financial advisor before making any investment decisions. Now, moving on to the investor profile for this particular opportunity, this is suited for those with a medium-long-term outlook. The recommended action here is to wait for the listing. Both of these companies, VISL and MEL, are starting with near-zero debt, which indicates an excellent balance sheet from the outset. This is a strong structural advantage, especially given India's ongoing infrastructure boom, which acts as a tailwind for steel companies like VISL. Meanwhile, MEL, which operates in oil and gas, benefits from a focused exploration and production strategy. So the key here is patience. Wait for the listing to allow price discovery before taking a position. Essentially, let the market set the fair value first. For MEL, the focus is on oil and gas, and for VISL, it's steel. Now, moving to the next profile, the conservative to moderate investor. The action here is to buy on dips or hold. The standout here is Hindustan Zinc, where they hold a 64.9% stake. It's a pure zinc play, and HZL is known as a cash machine with world-class margins. The stock is trading in the rupee 289 to 300 range after the ex-date, so the advice is to buy on dips with a target of around rupee 325, according to ICICI Direct. Master Trust also recommends accumulating on dips, aiming for that 300 level. Next, we have Vedanta Limited, which is residual in this context. For those with a more aggressive growth appetite, the recommendation is to buy on listing. Vedanta is India's largest aluminium producer, and ICICI Direct considers it highly attractive, with an expected listing valuation exceeding rupee 400. Aluminium demand is driven by sectors like EVs, infrastructure, and packaging, which bodes well for future growth. Plus, Vedanta boasts strong EBITDA margins, and as a large-cap company, it will likely attract institutional interest right from day one. Finally, VAML, or Vedanta Aluminium, is our top pick here. It's a strategic move for those looking for high potential. So, to sum up, whether you're a cautious investor waiting for the right entry point, or an aggressive one aiming to buy early, these stocks offer compelling opportunities aligned with India's growth story and infrastructure development. Let's wrap up with some important disclaimers. This presentation is purely for informational purposes and shouldn't be taken as investment advice. I strongly recommend that you consult a SEBI-registered investment advisor before making any investment decisions, as stock markets inherently carry risks. Now, shifting to the specifics of Vedanta, the demerger represents a significant structural value unlock event. When we look at the combined SOTP valuation of over 800 rupees versus the pre-split price of 773 rupees, it suggests there's meaningful upside potential here. For our best buy, I would highlight VAML, the aluminium business, especially on listing. It's the largest pure-play aluminium story in India, with a target price of over 400 rupees. In the hold category, Vedanta Limited, particularly its residual business, stands out, mainly because of its zinc franchise through HZL. We're looking at a target range of 300 to 325 rupees for this. Then we have some watch items, MEL in oil and gas and VISL in steel. For these, I suggest waiting for the listing price discovery to better understand their valuation and market response. TSBL, which operates in power, is known for stable cash flows and could be a good pick for income-oriented portfolios. Now, moving to the investment conclusion, there are some key risks to keep in mind. Listing delays are possible if SEBI approval takes longer than expected. Commodity prices, especially aluminium, zinc, and oil, are quite volatile and will impact earnings. There's also some uncertainty around debt allocation until the final disclosures at listing. Promoter holdings and the parent company's debt concerns around Vedanta Resources are also factors to watch. Additionally, global macroeconomic headwinds like the strength of the US dollar and a slowdown in China's demand could influence performance. Finally, the price discovery process for the new entity may cause some short-term volatility when it lists. So, these are important risks to monitor as we navigate this opportunity.